When most people think about the Forex market, they picture pairs like the euro against the dollar or the pound against the dollar. The United States dollar sits at the center of nearly every currency relationship. But not all trading involves the dollar directly. That is where synthetic pairs come in. A synthetic pair is a currency pair that does not include the dollar, yet its price is still influenced by it. These pairs are sometimes called cross-currency pairs. Examples include the euro against the pound against the yen, or the Australian dollar against the Canadian dollar. What makes these pairs interesting is how they are priced. Even though you might be trading the euro against the pound, the market still looks to the dollar to calculate the value between them. In other words, the relationship between the euro and the pound is built from the relationship both currencies share with the dollar. To understand this, imagine two currencies sitting on opposite sides of a triangle with the dollar at the center. Each currency has its own exchange rate against the dollar. When you trade one against the other, the market essentially compares their individual rates to find the price of the cross pair. This process is called triangulation. It is what allows the market to maintain consistent pricing between all currencies at once. Without it, the global Forex network would be full of small inconsistencies that traders could exploit instantly. Synthetic pricing keeps everything in balance. When the dollar strengthens, it affects nearly every cross pair because both currencies in that pair are connected to it in some way. The effect might not be direct, but it is always present. For example, when the euro weakens against the dollar and the pound remains stable, the euro also tends to weaken against the pound. The change does not come from a direct trade between those two currencies, but from the way their individual relationships with the dollar shift in relative value. This is why traders often watch major dollar pairs even when they are not trading them. The dollar acts as an anchor. Its movement ripples through every connected pair, creating opportunities and risks in unexpected places. Cross-currency pairs can behave differently from dollar pairs. They often have wider spreads, and their price movements can be more complex, especially during periods when the dollar experiences volatility. For traders, that means understanding how synthetic pairs are built is essential before deciding to trade them. At Vestra, we encourage traders to look beyond what is visible on the chart. Knowing how pricing is derived helps you interpret correlations between pairs, identify strong or weak currencies, and avoid confusion when markets move in unexpected directions. Synthetic pairs remind us that the Forex market is deeply interconnected. Every currency reflects a web of relationships built through global trade, interest rates, and capital flow. By understanding those relationships, you can see how money truly moves around the world. Trading always involves risk, and returns are never guaranteed. But education helps turn complexity into clarity. When you understand how cross-currency pricing works, you are not just reacting to numbers on a screen. You are reading the structure of the market itself. Content is for educational purposes only, not financial advice and FSP number.